Welcome to the Trading with Venus podcast, where we help you establish strong trading habits, generate consistent profits, and create the lifestyle you desire for yourself and your family. Now your host, Raman Gill.
Hi, welcome to another episode of the Trading with Venus podcast. I'm your host, Raman Gill. I've been asked this question many times, so I thought I would bring it up today. How does liquidity impact our trading? What is liquidity, first of all? Liquidity is the number of transactions that are going through the market. So if we think about any kind of market, when there are more buyers and sellers in the market engaged in transactions, when it's the busy time, that's the best time to actually make money. However, when the market is slow, any market, let's say farmers market, when it's slow, there aren't that many stalls, there aren't that many buyers, there's no business there's barely any money being made by anybody, any transactions going through. So liquidity means the number of buyers and sellers in the market, number of transactions that are going through the market. So how does liquidity impact our trading? The reason liquidity has such a big impact on our trading is because, going back to the same farmers market concept, when there are more buyers and sellers in the market, when there are more transactions and more money flowing through the market, it's easier for us to make money. So it's like throwing a net out. If the river is full of fish, you'll be able to get more fish. However, if you are fishing in a stream where there isn't much going on, little water, little fish, you won't catch as much. So liquidity plays a very important role in our trading. Now, when are good times to trade, keeping in mind liquidity? So we talked about in another episode, what are the good times to trade from a day-to-day perspective. So in day-to-day perspective, London and New York sessions seem to have the most liquidity because that's when most of the world is up and there are a lot of transactions going through the market. So as a result of that, liquidity tends to be high in the London session and the New York session. So those are good times to trade, and because there's more liquidity in the market, prices will move more because of people going back and forth doing transactions. And as a result of that, more movement in the market, which means there is more room to make money. It's like an abundant river, lots of water, lots of fish. You can actually take money out of the market, because if your daily range, or if your range for the London session is 100 pips, you can get 40, 20, 50 out of that market, and it's relatively easy to do that. So London and New York are good from liquidity perspective and easier to make money from a day-to-day basis. Now let's take a look at a year as a whole. When we look at that, the best times to trade are actually in the fall. So mid-September to about mid-December are good times to trade, because a lot of people are back at their desk. They are trading. The year end is coming up. So big institutions need to show some profit. They need to close their books at year end. So everybody's focused on work and hitting their goals, because the bonuses are tied to the goals. So the better their performance is, the bigger the bonus. So a lot of institutional traders are focused on basically pumping up their performance records so they can actually get that big bonus. So from that perspective, they are more engaged in the market. When the big fish is in the market, that's always a good time to be in the market. So we follow the institutional traders. They are back to work, we are back to work, and we ride their coattails. Where they're going, we can follow along and make some money out of it. So mid-September to mid-December, good times to trade. Now, when we get into that Christmas season, a lot of people start thinking about holidays, about being away, taking time off over holidays. As a result of that, the transactions drop. So number of transactions will be far less during Christmas time than they will be, let's say, beginning of October. So that's normal, because if you look at office workers, they don't want to work during Christmas time. Everybody's thinking about what gifts they're going to buy, what they're going to do, what dinner they're going to make for Christmas Eve or Christmas Day, that kind of stuff. Everybody's in the holiday mode, and as a result of that, they're not really pushing trading, and so the river kind of dries up, and we don't have as much room to make money. The market is still open, however, because there are less transactions, prices will get pushed around and there'll be more volatility in the market. So not the best time to trade. So when we go back into about mid-January, people are back from vacation, from taking time off, and we are back to work. So the first quarter is always a good time to trade. There again, it's a new year. People have New Year's resolutions. Same with institutional traders. They get new goals for the year and they're back to work. As a result of that, a lot of transactions going through the market, lots of liquidity in the market, and we can join these participants and make money from the market. So mid-January to about end of April and even May, those are good times to trade. Now, when we go into the summer holidays, summer months, a lot of people will be away on holidays, especially in Europe. A lot of people take time off as a result of that, especially with kids being off during summer. This is the time, and we have to think about it like this. The person who's trading is a human being. So what impacts their life? If the kids are off on holidays, then parents will start thinking about what are they going to do with the kids. So they'll be in the summer mode as well, because they will have those pressures from the other part of their life, and as a result it will impact our trading as well. And that's why the liquidity drops off, because a lot of parents will start booking time off. A lot of traders, if they've had a good first half of the year, they will think about taking time off, and as a result they will start booking their holidays. And after trading for 6 months, you need a break. A lot of people, with sun shining, good weather, everybody wants to take a break. As a result, a lot of institutional traders go way out of the market, and it's usually the newer traders and the junior traders who are running the show at these big institutions. As a result of that, they don't have as much authority to take huge orders. They can manage their positions, they can take some trades, but they don't have the same level of authority that the senior traders can. So when the senior traders are off, market tends to slow down as well. So summer months, liquidity tends to go down. And when liquidity go down, so what happens during the market if the liquidity is low, and why do we need to worry about it? With liquidity being low in summer months, it tends to push prices around. So think of it like this. If you have a leaf that's flying around in the wind, if it's a small leaf, really dry, small leaf, it will get pushed around by the gusts of wind. However, if you have a big leaf and it's full of moisture, it won't get pushed around as much. It will still get moved by the wind, but it won't just fly away very easily. High liquidity months are like that big leaf where it gets pushed around, and once it catches that gust of winds, it'll keep on going in that direction, whereas this dry small leaf will get pushed around. Every time there's a gust of wind, it'll get pushed around. So during low liquidity months like summer months, we'll see a lot of these quick price moves. Well, price will go in one direction, some comment comes out or a large order comes out, and price will just shoot up or shoot down, and then something else happens and it just reverses direction. So price is a lot more erratic over summer months and during low liquidity periods, and that's why it's important for us to understand when is the market most liquid, most of transactions going through the market, so that we can take more transactions during those times. We can do more trades during those times, because market will be steady and we'll be able to actually gauge what the market's gonna do, and prices won't get pushed around like crazy. Because when prices get pushed around, when you don't know why price just shot up or went sideways or went down, that's when it's not a good time to trade. So during high liquidity months, it's more steady market. If things are normal, price will react to things like it normally does, not have this jittery price behavior where it just get pushed around just because somebody said something or tweeted something. So that's the difference between high liquidity time and low liquidity time. So just to recap, High liquidity times are between mid-September to mid-December, good liquidity, and then mid-January to about end of May, good time to trade, high liquidity in the market. And the low liquidity times that are more volatile times are summer months and also Christmas break during that time, and then when people get back on track with their as they get back into trading in January. So the first couple of weeks of January, last couple of months of December, and the summer months, especially July, August, those tend to be low liquidity months. So it's best to kind of tone down our trading and look at other things that we need to do where we enjoy some time off, or also take a look at what needs to change, right? Do a review of our trading and see what we need to change, where do we need to adjust. Those are some of the things that are better to do during low liquidity months. And when we are back into high liquidity months, it's time to trade. And good news is we're going into those times now, so there will be lots of opportunities to trade. So keep your eye on the market and make sure you take advantage of those trading opportunities. So that's it for today. If you like this episode, please share it with your friends, put a comment, and give us 2 thumbs up. Hope you have a great trading week, and I'll see you next time.
Thanks for joining us today. With much gratitude, your show host, Raman Gill.